Welcome, everyone, to the second quarter global markets and economic update. As you see in my tagline here, I'm Chris. This is my colleague, Brian. The purpose for us hosting this event is to bring information to you so that you can have an idea of some of the work that we're doing behind the scenes. Additionally, give you perspective on the globe and the US. I think that there are times we're presented with information, which we're presented with select information to cause fear and doubt in our own planning. And that's just the reality of the world that we live in now. And so our attempt in this area, our focus in this area, is to give you a broader perspective on the data so that you can feel more confident. And as Brian and I were preparing, we're not trying to just paint rainbows and butterflies about everything, but have context and not, sort of like select what's called data mining. So any questions, please put them in the question and answer. This is our agenda. So we are going to start with the global economy. We have a number of bullet points that we're going to cover here. We'll dive into the US economy, more specifically, US equities. Then we'll shift our perspective to international developed. We'll talk about emerging markets. And then we'll talk about bonds and interest rates and where our focus is in this area. And then lastly, some charts to remember. So let me jump in, and Brian and I are going to bounce back and forth in terms of the presentation of our charts. Oh, and we've been given feedback about the size of the screen, so definitely aware of that. At the end, please give us your feedback. There are 5 super short questions. Shouldn't take you more than a minute to answer them, but I always welcome and ask for that feedback because we want to improve this presentation as we continue. So this chart from Fidelity is showing the business and economic cycle here. So for the US, we're in the late cycle. So these bullet points are things that we're seeing now. So earnings are coming under pressure. Credit tightening, meaning the Federal Reserve is raising interest rates. Growth is starting to slow down a bit. Interestingly enough, you see China sort of ahead on their economic cycle, having had a longer lockdown during COVID, and the UK and the Eurozone are here. And so in terms of anticipating what we're expecting to see is a potential recession. Brian and I, we attend a lot of these calls with JP Morgan and other financial companies, and it's like this recession is like the most promoted recession ever. It's like not a surprise for anyone if or when it shows up. So some of the behaviors, we'll see falling activity, profits declining, policy ease, meaning the Federal Reserve lowering interest rates. So let me pause here. Brian, other points about this slide that
And mainly a lot of globally, countries and regions have become a little bit more decoupled. As mentioned by Chris, the COVID restrictions have kind of helped China, at least in the services. Granted, it still may have some fits and stops along the way, but at least from a service perspective, China is starting to lift up, and eventually manufacturing may start up again. So they're starting to come out of the recession. On the outside of the U.S. In Europe, the less than expected, I guess the warmer than expected or warmer than typical winter has helped reduce recessionary risks there, at least in the near term, as well as improve, the consumer and business sentiment. So things have decoupled a little bit, but we'll see. As you can see from the cycle there, right, with China coming out, with the US anticipating to go in, UK, Eurozone, a little bit, maybe somewhat in a recession phase, but overall things have decoupled a little bit internationally.
So we have a variety of charts. These are, you'll start to recognize them. These charts come from Charles Schwab. And so we focus in a couple areas. This first area are leading economic indicators. So what are we expecting in the future? And we see some of the leading economic indicators coming down, although when you focus in this area, so purchasing managers index, if you're above 50, it's an indication that things are growing. So we're getting two different bits of information here, because in the dark blue, you see the Eurozone and Japan. Well, they're all above 50. The US above 50. The same with China and even Russia. So even though we're seeing some of the leading indicators suggesting there would be a slowdown, could be a slowdown coming, on the opposite side of this chart, we're seeing actually not there yet necessarily. The JP Morgan has a similar chart. They call this is more like a heat map, for example. And so in red, this is COVID. So this is the COVID lockdown right here, where essentially the entire world shut down, and then things starting to ease. And so with what you see on the left-hand side here, this is the global economic activity. And Brian made mention this. So it can be broken down for manufacturing and services. So there are two different pieces that we're focused on in this area. So manufacturing, for example, is slowing down, but services you see is rising. So more of a, what interactive people providing services. So these are charts that we continue to look at. Brian, anything that I'm leaving out?
And just really looking at that previous chart and this one here, I mean, even though PMI has gone up, the important thing to note is it's a combination of manufacturing and services. So the services piece is really driving the PMI now. So even though you see the PMI, overall PMI level growing, there's a partial offset by the declining in manufacturing PMI. So just that will be kind of a theme throughout as we go in these other slides, as far as the kind of the dichotomy between the services and manufacturing or goods levels. That continues to play out as people get back out and post-COVID and are still enjoying services and traveling and stuff like that. That's one of the reasons why you'll see some of these figures being positive, as well as inflationary factors as well, some dichotomy between the two.
So you're reminding me that another thematic thing that I want to leave each of you with is to ask yourself, am I being asked to ask myself the right question? So data mining can be taken just in manufacturing and presented to you to say, manufacturing is declining, these things are happening. Am I being at, what is the context of what I'm being presented? Because my 2 cents is that we're constantly being affected by data mining and presenting part of the story that drives sort of anxiety. So anyhow, I'll try not to go off too much on that, but I wanted to highlight a little bit of those points. Okay, so we're still in global unemployment. This is in part why we're going to talk about inflation, have ongoing inflation. So it's not just, so you see the US here, overall unemployment quite low. That's, we've known that, and there are more highlights for us to share here. And even if you look at China's unemployment is low, Eurozone low, and this is all the way back to 2008. So, 10 years ago, unemployment in Europe was higher than it is now. And in Japan, you see unemployment quite low as well. So this is very, very positive for the globe in general. Although on the flip side, it's what's also driving inflation. It's because so many people are working and there are so many dollars floating around. The definition of inflation is more and more dollars chasing the same or fewer goods and services. That's the definition of inflation. So, okay, so here's global supply chains and inflation. So what are the suppliers' delivery times? So we all remember COVID and all the boats that are off the coast of California, and there was all this delay. Well, that has dropped dramatically. They're faster and faster delivery times. When we presented this chart last time, the purple dot was up here. It was above 50. So things are being delivered faster and faster. And then what about the price? So we have the input prices in purple here going down, and naturally the output prices are going down. So we presented this chart last time, and here again, things are being delivered faster and prices are declining. Brian, did I leave anything
And
out?
this really, one of the parts of this slide is basically, this comes across in the PMI decrease for manufacturing. So inventories are starting to build up a little bit. Manufacturing is getting better, as well as what we'll see here in a few slides down the road is goods inflation has decreased. So these are all factors. Delivery lead times, input prices are all factors into both all to PMI as well as inflation from the goods side, not the services side.
Global inflation. So global inflation is going down. We've been experiencing this. So these are the 7 major, corporations, and then here's emerging economies. So, coming out of COVID, I mean, well, I'll show you the next slide, but it's like we want to enjoy our life. We want to spend money, have experiences. Inflation is coming down in general terms. This was interesting. We thought we would share. So you can see in the UK year over year, it's 10, Italy 9. So Europe in general 8.5. Here we are with the US at 6. In some lower countries down here, Japan 4.3, China is 1. This is a similar heat map from JP Morgan, and so up here is the globe overall. You have developed markets and emerging markets. So we include this slide because you're going to get all of these slides in the follow-up email tomorrow. So for people who want to spend more time diving into the details, you can see not only the 2022, but the month to month. What we're wanting to highlight more than anything is that quarter over quarter, inflation is declining. Well, there's another slide that we'll go over about each specific piece to inflation will highlight that. I think actually that's when we get to more US data points. Brian, anything I'm leaving out about global inflation?
So even though it's coming down, it remains high. So as you can see on that heat map, as far as so there's still more work to be done. We'll get into a little bit more central bank policy, but we'll see where once central banks, now that they're nearing the hiking cycles and level things off, how that will impact inflation going down the road. So, but we already can see some of those effects early on.
Okay, so central banks around the world are dealing with inflation. How are they dealing with inflation? So in the US, this is our US Federal Reserve in blue. So we see interest rates rising. This is the European Central Bank in this lighter blue color. We have the Bank of England here, rising. Here's China in I don't know what you'd call that, yellow. China has actually been lowering their interest rates. And then you have the Bank of Japan, which is in this much lighter blue. The Bank of Japan's done nothing. They're not having inflation really as much. So we like to present this chart because additionally, and then we can show this JP Morgan chart, which shows, okay, what are the expectations into the future? So in gray is the US, the Federal Reserve. And so the Federal Reserve meets every 6 weeks. So 10 times per year. They're meeting next Tuesday, Wednesday. We're expecting interest rates to rise again, and we'll find out by the time we get to next Thursday. And so that's where you're seeing the expectation is that it will increase. So 6 weeks from early May is going to put us into mid-June. So there will be, and I think interest rates will rise again by 0.25% because the inflation isn't, to Brian's point, it's still elevated. So there would be good reason to raise interest rates one more time. So potentially between now and the next time we're making this presentation, which is at the end of July, we could see 2 interest rate increases by then. Well, the expectation is that I'll just say what I think. I think that they're going to pause. It'll be flat for a period of time, and then naturally interest rates will decline. I don't think that it will happen in 2023, but in some point in 2024, interest rates will come down, and rightfully so. Well, when you look at the European Central Bank in green here, the expectation is that they're going to continue to raise interest rates through the summer. Here's the Bank of England. Expectation, continue to raise interest rates. Well, we just saw their inflation numbers. So that's why they're going to continue that trend. Because while it's coming down, it's still elevated, to Brian's point. And so here's the Bank of Japan. The Bank of Japan's all the way down here. And I go, well, yeah, we're going to raise interest rates in the future. So Brian, let me pause here. Anything I may have left out?
No, really, the key message is we're closer to the end, and all of them, all the major markets, maybe the exception of Japan, developed markets should be ending the hiking cycle this year, and then we'll wait and see, based on the data, what each central bank does as far as reducing the rates, either latter part of this year or more likely in going into 2024.
Mm-hmm. Okay. Shifting gears to the US, this is GDP is another name for growth, the growth of the United States. And so what you can see here is quarter over quarter. And so this last quarter measurement was in the fourth quarter of 2022, and we had 2.6% growth. This coming Friday, there's going to be more economic data coming. That's going to have the first quarter of 2023, and that number is expected to be pretty good. But the area that Brian and I focus on here, when you see year over year, what we see is a declining trend. And so that's in part where we see part of the slowing economy. And when we go to the next chart, this is JP Morgan. JP Morgan's assumptions anyway, and they could be wrong, is that for the entire year, it would be 0.3%. I think that would be a little bit low, because I do think that once we get this updated number here for the first quarter of 2023, that we'll see a decent number. And so if JP Morgan's thinking is going to be 0.3, that means in the second half of this year, things would meaningfully slow down. But to Brian's point, we're going to be watching and looking at the data on an ongoing basis. So it's not like we'll be missing any of these details. One thing that I wanted to highlight as it relates to federal finances is that we have a dysfunctional government. And so we have this debt ceiling coming, and I want to keep this piece brief, but I'm hoping they play nice in the sandbox, raise the debt ceiling, and move on. Would it be good if we cut expenses? Yes. Is it possible that the United States would default on the loans, which is the whole point? The answer is no. As much as they want to play this game of chicken and come out ahead, we're not going to default on our bonds. The net interest is 10% of the budget. And we've seen this before, and the government shuts down, and everyone from NASA has an unplanned vacation, and then 3 to 5 years later, they figure it out and everyone gets their money back. And so I don't want to go off too much, but please don't be feared or bothered by the debt ceiling. It's a unfortunate charade in our dysfunctional politicians. So I just wanted to highlight the fact that we're not going to default on our bonds. Let me pause here. Brian, anything data related that I left out in these two charts?
Good.
Okay. Let me turn this one over to you.
Yeah, so as we see, as far as the labor market, as mentioned before with unemployment, it still remains tight. Looking at the upper left, I know some of these numbers may be hard to see, but in summary, job openings is stable, actually increased a little bit, while the unemployment rate remained about the same. So we still have, you know, for every about 1.8, 1.7 even jobs for every unemployed person in the US. So, you know, eventually part of the Fed's objectives is to kind of close that number a bit. So whether that's job openings going down or unemployment going up a bit, that's ultimately will, you know, help ease inflation. And then on the upper right, as noticed, the job labor participation rate. So over this last quarter or so, the labor force participation for 25 to 54-year-olds has gone up about, I think it's about 0.25%. Meanwhile, those 55 and older has gone down about 0.25%. So overall, it's about net zero, but just kind of a note to look at the participation rate, especially of the typical, I guess what folks consider more of the working age is 25 to 54. That's been steadily increasing since mid 2020. And this is the black line here is showing the unemployment rate. We're currently at a 3.6 level. One thing of note, though, is the wage pressure, which ultimately follows through into the inflation side. The wage pressure has subsided. So now, while we're still over the average, the 50-year average, we are still our wage growth has seemed to at least peak for now. So we're right there and decreased over. So that should help ease inflation, both from manufacturing and more importantly from the services side.
Mm-hmm.
Staying on the wage inflation front, one interesting note that we saw, got to the slide from Fidelity, as you can see, looking at the left-hand side here, the wage increases have actually helped the bottom decile of wage earners more so than the upper deciles or upper quartiles. So the wage disparity that kind of gets communicated and out by various channels, as you can see, the wage growth has helped both from a weekly average earnings from the bottom decile, as well as looking at the lowest quintile, it's actually improved the net worth by a greater percentage. So at least some of the wage growth we've seen has fallen. It hasn't fallen to just one of the age wage earners groupings. It's actually helping the folks that make the less money. So, as far as what you see maybe in services and restaurants and other service industries, that's coming through from the latest activity.
Yeah, it's good. Good to see.
So
yeah,
go ahead, Chris.
Well, so this is so First Trust is giving us this data on inflation, and so one of the challenging pieces sometimes is when we say, okay, here's the total inflation, but these is the core inflation, and what's not part of core inflation are things like fuel and other that we deal with more, and so that's why you see this bigger gap here, and both total inflation and core inflation is starting to narrow, and they're both moving in the right direction. And so when we show this in more detail with Charles Schwab's chart, you see the same thing. So in this, so here's the core in this lighter blue line where you see the core coming down, and then you have goods in this, overall here. And so energy, what we've seen is a decline in energy. The cost of energy has come down. And then to Brian's point here about services cost continuing to rise. And people who are renting, they're seeing rising rates in rent. This chart I find interesting because First Trust is showing us more specifically where some of this inflation is coming. So airfare, year over year change, 26%. Anecdotally, in my opinion, people were ready to travel. The price of the airline ticket matters less than the desire to get out and travel. What's interesting, though, is so gasoline prices have come down. There was used car prices were, are now coming back to more normal areas. But we still do see higher price in food when we're going to the grocery store, and here's higher price in housing. So not only have the values of real estate risen, but we also now have higher interest rates, which means, of course, higher cost to buy. And I always laugh at this one. TVs. It's like you can get a flat screen from anywhere now, and the price is going down, 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 down. So we thought we would, break out a couple of pieces specifically. Brian, anything that I may have left out in these last few charts here?
No.
Okay. We included this to give some historical perspective on inflation. So here's what we've been experiencing. The late 70s and early 80s, we had double-digit inflation for over 10 years. So we never actually hit double-digit inflation, and inflation is declining. We're just wanting to share that historically we've had higher inflation, and we've gotten past it. So moving in the right direction. And so when the S&P, so let me just read this, usually positive after peak inflation. And so this is another piece about data mining in the sense, or even just our natural world is like our phones buzz, 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 buzz. And, we're getting these reports like, how did I do this week? How did I do this month? And I would suggest it's like, ask myself, like, am I being asked to ask the right question? Is this the right question I should be asking myself? Because when you look at a 3-month, 6-month, and a 1 year, and these are just historical data from the 70s to the 90s, they're all positive. So what ends up happening is we can be drawn to this micro measurement, which Brian and I would suggest is not the right measurement. We want to measure on a more long-term basis. So there are data points to suggest that even if we go into a recession, it's part of the economic cycle. We'll get past it. And when you look at these more forward-looking data points, we see positive results. Okay, Brian, let me turn this one over to you.
This chart here just depicts basically, we are still spending down. So after the government subsidies, as you can see here, the consumers had a excess of savings. While consumers have not depleted those savings, it has been coming down gradually over time. So we still have $1.2 million, $1.2 trillion of excess savings to go. But that trend is going down from the stimulus. Personal savings rates, which we'll see here and also here shortly, it's still lower than historical. So if you look at pre-COVID, back in October, look at the latter part of 2019. So folks are out spending, on goods and more recently more on services. So consumer savings rates are below the pre-COVID norms. So even though we have consumers tend to have excess savings from the subsidies, the savings rate today, even with the high wages, is less than we've seen in the past.
Okay, so I put this in here on purpose because this to me is an example of data mining. So First Trust gives us a lot of good data, and I appreciate their data. But when you look at this chart, which is credit card balances from 2008, they've risen. So here's COVID stimulus, people paid down their credit card debt. Good decision. But then you see this, and to me, what I see is fear, doom, and gloom. Well, when you look at the JP Morgan gives us a little bit more context. So revolving consumer credit card debt, this is the same chart, only you take it all the way back 20 years. So yes, consumer credit card debt is high. It is a concern. But let's compare this to the percentage of disposable income. What is it as a percentage of cash flow? Well, it's 6.2%. So what that means is that people are making more and more money. And so the cost of that outstanding credit card debt is within the same range. It's actually lower than it's been over the last 10 years. And then when you look 10 years prior, people were spending more on credit cards. So it's not, I mean, obviously most people on this call don't have revolving credit cards, but a lot of people in the country do. But I'm just trying to highlight that there are data points that we can get that drive fear, but if we put them in a different context, it's not as much doom and gloom as sometimes we get presented. And so to Brian's point about the personal savings rate, so people aren't saving enough. That's the reality. And in the 60s, 70s, and 80s, people just naturally saved more. And it was really just a different time. It was a different economic time, different social time. People behaved differently. And so from the 90s and beyond, people haven't saved as much. So that's just the reality of, I guess, the dichotomy of our country. And I don't want to belabor this point too much, but more than anything, wanted to highlight looking at a broader picture. Brian, anything I'm leaving out?
No, and it's really just an emphasis, like as you see there from the last couple of years or prior to this, I guess 2020, 2021, when we got the stimulus, that personal savings rate went way up. And now we're kind of this last year and this year so far, we're kind of undershooting the average. So we're basically, and that's what we depicted earlier, the excess savings that went into place during the stimulus. We're not saving as much, but we're burning down that savings that we had in the previous years from that stimulus. So,
Mhm.
and this is here just I know we get, as mentioned before, we're not in a recession yet. These are the variables used in officially declaring a recession. So you can see this is the updated numbers here. So as you can see, during the COVID period, we're all in red. Now looking into February, while none of the signals are red, they're still not all in green either. So so these are the official determinants. So just want to make sure that folks, this is what the NBER uses in making them. So while it's not all rosy, things are declining a little bit. The growth is declining. So we'll see as time goes on if we do get into a limited, I guess, a brief recession or slight recession here in 23 or following year.
Diving a little bit deeper into the US and profit margins themselves. So we've been presenting the possibility, the likelihood of a slowing economy. However, that doesn't always mean bad results for your nest egg. And so one of the areas that we focus on are profit margins. And so the profit margins at the end of last year is 10.9. And when you go back 30 years, you see, and this is the largest 500 companies in the US, profit margins typically had been lower. And so sure, they went up slightly before COVID. Everything got shut down in COVID. Profit margins have risen. But it's not the end of the world if some profit margins go down, in part because we're having to pay people more for labor, because we know we need to keep the employees, so they're paying to retain them. Probably people on this call have experienced, like, you go to a restaurant, the restaurant's half full in terms of clientele, and then they tell you got to wait 45 minutes because they don't have staff to service even a half full restaurant. So paying people, hiring people, yes, more input cost for salary, for payroll is going to lower profit margin, but at least you're able to drive revenue. So, it's sort of the chicken and the egg a little bit there. And so Fidelity does a good job with this chart saying, just because corporate earnings go down doesn't always mean that your portfolio goes down. So on the bottom, you have this 12-month year-over-year earnings per share. And so these are positive. So this part of the chart does not apply. This part of the chart is what we're looking at, the potential and expectations for declining earnings. And then this is the S&P 500 year-over-year performance. And so periodically, yes, earnings go down. The S&P 500 goes down. But there's a whole bunch of data points that would give us evidence to say, just because earnings are going down doesn't always tie directly to portfolio values declining. And so, Brian, let me turn this one over to you.
Yeah. So we'll go a couple of these. We'll just go through real quickly, or just hit a highlight, because I know we've got we want to try to allow some time for Q&A or answer any questions we have. So this really just shows from our latest forward price earnings ratio, we're still a little bit above the 25-year average. So, depending on the valuation methods folks use, we are a little pricey if you look at the S&P. Relative to growth versus value, and this is really plays, we remain historically value versus growth, relative valuations. We are still value is considered a little less expensive than growth. So along the lines of what we've done in the past or the last couple of quarters, we are still tilted towards more larger cap companies, value, which is typically associated like dividend payers, dividend growers. So we still have that tilt within the portfolio, and given the circumstances with the slowing economy and the retraction or and earnings growth, just a little bit more of the defensive side. From a international versus U.S. perspective, we remain U.S. is relative to international. International is a lot from a valuation perspective cheaper than the U.S. So up here is really depicts the relative values, and then up here is the true value. So as you can see, historically, the current ratio for international is lower than the historical, and relative to the US, it's a lot cheaper. In the same way for the dividends. So over the last quarter or so, and then probably continuing into this quarter, we've gradually, not wide scale, but we gradually have increased the allocation to international, and likewise decreased a little bit of the US domestic. And this is a lot of the drivers is based on this extreme valuation difference between the US and international.
Mhm.
And this is really another depiction, just to emphasize, within international, the developed markets, the blue diamond represents the current valuation. The 25 year average is reflected in the purple. So as you can see here, especially in developed markets, historically, the valuation levels are below the norm, and where the US is slightly above.
Yep.
Sorry.
Actually, yeah, you can cover this.
Yeah. And
that's good.
then lastly, on the equity standpoint, everybody, all the portfolios the models have an allocation to emerging markets. And this is an update of the slide we showed last time. Emerging markets, as can be seen here, as a percentage of GDP, it's actually grown since 2021, and it's now sitting at 43% of the GDP. So that's one reason why we do include emerging markets as part of the allocation for all of our models. Here you can see the non-US developed markets, and then the US portion. And then just from comparison standpoint, you can see where emerging markets has become a larger portion, primarily at the expense of non-US developed markets over time.
Okay. We're going to shift our gears now to talk about bonds. As we get towards the end, please add any questions into the chat area there. We'll make sure that we answer your questions. Okay, let's talk a little bit about bonds. So interest rates have been rising. We've been experiencing this over the last year. This graph here is from December of 2021. This is called a yield curve. And so when you look on the bottom, you have the years. So typically, this is what the yield curve looks like, which is the longer the term of the commitment, 20 years, 30 years, you get paid a higher rate because you're willing to loan that money to the bank or to the government for that period of time, and you typically receive more. And if you want to have your money in cash and very short-term type structure, you're not going to get paid much. Well, that has changed. So these are the rates that you're seeing now, March 31st, and then as of the end of the year. So what you're seeing is the rates now are higher now than they even were at the end of last year. And so some of what we've focused on within the IRA model is shifting towards buying CDs and getting that short-term fixed guaranteed rate, because look, these types of rates are really competitive. And why wouldn't you do that when if you go down this scale, you're going to get paid less? Well, part of that is also because interest rates are likely reaching their peak. Again, I think we'll see an interest rate increase next week, and I think we'll see another one in June just because inflation is still high. Again, we'll have a pause and then interest rates will decline. Well, what happens when that happens? So, for example, this chart from JP Morgan shows when interest rates decline, if you imagine a seesaw and interest rates go down, bond values increase. So we see a number of positive metrics in terms of interest rate decline. So moving from a CD, which we're getting really competitive rates now, we're migrating the portfolio and not getting rid of CDs completely because we still have a little bit of time in the next 3 to 6 months and see how we do through the summer. But leading into the fall and into 2024, we are expecting interest rates to decline. And I think that's a reasonable thing to expect. And so this is a chart that Brian and I focus on in terms of deciding where do we want to migrate our bond positions. And when you look at the CD rates and fixed income opportunities, what we're shifting towards are things like US investment grade bonds and US treasuries, a little bit longer down what's called duration. Duration is like a CD. If you have a duration of 5, it's like a 5-year CD and you get that rate. And so when you see here like a US Treasury 5-year bond, now this is not an indication of, this is just historical data. We're focused on these numbers and deciding how do we want to position the portfolios in the next 12 to 18 months to do well as we expect interest rates to decline. And so these are some of the data points when you reach peak CD rates, which we're expecting to reach maybe by the summer or maybe just after the summer. And then how do we do after that? So the vast majority of the time we see healthy returns in even our more conservative investments. And after the year like we had last year, it'll be nice to see some positive returns in our more conservative investments. And the other piece that we see and focus on are something called the default rates. So we're not migrating into high yield bonds because high yield means low quality. And so lower quality companies, you'll see the default rate is in blue. Default meaning they can't pay their notes. The default rate is increasing. So this is happening now, and this is something that we continue to monitor within high yield bonds. And so the average right now is just over 2. The long run average is at 3.5, but this trend is moving in a direction that would say this is not an area that we're wanting to, move in currently. And it's just one of those sort of things that we view. The example of not everything is rainbows and butterflies. So we're seeing some of this happen now. Brian, anything else in this area?
So it's mainly and kind of, so one of the things you'll see us doing, to Chris's point in this, is we'll start going into some of the, while CDs are earning a good rate, now that the Treasury, now that the Federal Reserve rate hiking cycle will be coming to a close here within the next couple of months, and then eventually level things out. We're starting to position, I think Chris has said this before, we've got to kind of think a couple chess moves ahead. So while we're not necessarily leaving CDs completely, we are going to start positioning portfolios, the fixed income portion of the portfolios, to start taking advantage of the situation where rates stabilize and then rates are starting to fall, as you can see here. So this is where we're going to start placing our focus, this quarter, but also quarter, like Chris said, next over the next 12 to 18 months, we're going to start positioning, taking advantage of the fact that the rates will stabilize and then actually be coming down, and taking advantage of other fixed income options that we see.
Okay. Now we're moving into our last section, which we call these sort of charts to remember. And so this first one from First Trust shares with us what is being measured is the days of a plus or minus 1%, up or down. And the average is 66. So last year we had a really, really volatile year. The year before we didn't, but of course 2020 was volatile because that's when COVID started. And so far, about a third of the way, third of the way through the year, we're at, I'm trying to say that we're having a bit of a volatile year again. We're on track to have an above average volatile year. So if you're feeling like that's the case, yes, that is true. And it's just part of where we are. Having said that, this is a very good chart from Fidelity, which I really like. And so on average, long-term, we see about an average 8% return. Some years better, some years worse. But what are we going to have to put up to deal with that? Typically 3 corrections per year of 5% or more. And so what this translates to is your phone going buzz, 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 buzz. I mean, I'm trying to preempt the feeling of that stress. 1 correction of 10% per year, greater than 15% every 3 years, and greater than 10% every 6 years, which we had in 2022. And so as a result of this volatility, since 1926, we're positive in more than 7 out of 10 quarters, 7 out of 10 years, we're getting ahead. And so First Trust does this again, giving us a good perspective. So this is 2022. We ended up down 18% for the year. During the year, throughout the year, it was more, and we ended up a little bit towards the end. But they highlight the same numbers. 7 out of 10 times we end up in the positive. The vast majority of the time, we actually have the most in what's greater than 28% compared to all other metrics, but it's twice as painful to lose money. So part of the charts to remember is why we highlight this. Another way to look at this, these are our growth years in blue. This chart's a little bit small, makes it a little bigger. In yellow, we see when we're having losses. So we had a bit of this last year. We all definitely experienced the pain of that, but the vast majority of the time we're in positive territory. And then here's JP Morgan. So every year we're going to lose, we're going to see a dip. Well, just like Fidelity told us. That's what this red dot is showing us, that there will be a dip at some point. We just don't know when. But if we only look from January 1st to December 31st, the bar chart is what we would see. And so here again, the vast majority of the time we're in positive territory, over 7 out of 10 years, which is the same metrics here. And occasionally we're down and we end up down, but it's much less frequent. So what are the takeaways that we want to leave you with? The globe has become less synchronized. Basically, people are sort of retreating to their corners, in part because of Russia's bad behavior, China's bad behavior. And so there are things that are happening. There have been, one of the questions is being concerned about the dollar, and the bad actors are acting badly in broad daylight. And so them sort of trading, China and Russia and Iran trading weapons in non-dollar denominated metrics, that's all they have. But they're not trusted. They're not trusted countries. They're not, they don't have integrity. No one trusts China, no one trusts Russia, no one trusts Iran. So that's a little bit what we're seeing there. Inflation is declining, but it's not declining that rapidly. But employees are getting paid well, and so they're taking their money and they're going out and spending it. So part in my mind is like, inflation be damned, I'm going to spend money and have experiences. Slowing US economy draws our focus to corporate performance, focusing on larger companies and value and dividend paying companies. International markets are valued favorably to the US, so we're migrating towards some international focus as well as emerging markets. They're again similarly in value and dividends. Interest rates are going to level off over the summer and start transitioning into longer duration versus the CDs, which are very, very short, in anticipation of interest rate declines. So let me pause here. Please put any questions you have in the question and answer box. We'll be sure to touch on those. There are 5 super brief questions at the end. So there's going to be a pop-up of a poll. So please give us your feedback. We always want to improve, and we get good feedback each time. So I'm happy to be, we're happy to be guided in how we can improve. So please put any questions you may have in the chat box while we have a few minutes left, because I'm going to stop the webinar on time at 1 o'clock, because I want to make sure that we get the cue for you to give us that feedback. We can't get the feedback until I end the webinar. So let me pause here. Any questions? Let me come back. I'll come back to the front page, which is our invitation here. We host this webinar quarterly. So again, it's on the final Wednesday of each new quarter. So we're going to make this presentation in July, in October, in January again. We have our first question. So thank you. How do you see government debt influencing portfolios? So government debt, in the sense that we are spending, it would be nice if our government spent less. What I want to highlight is the cost of the debt. So these are federal finances here, and you see net interest is 10% of the budget. So we don't see government debt necessarily negatively influencing portfolios. Actually, if anything, the piece about government bonds is they are what's called negatively correlated, meaning that if there's some fear event, if China invades Taiwan, that'll be problematic. Likely some equities would go down, but government bonds actually increase in value because of the fear factor. So government bonds play an important role. I have zero concerns about the US paying the debt and funding the debt because it's only 10% of the budget. I have a bigger concern about our dysfunctional government not figuring out how to work out a compromise and going down this road of this game of chicken of, who's going to blink first, and are we going to shut down the government, and the mudslinging. The mudslinging is a bigger concern. Go ahead, Brian.
No, that's good.
Okay. Okay. Other questions? Okay. Our dollar acquisition power appear to be declining. Our gains erode the small earnings. So the US dollars, and I'm not sure if this is related to sort of what I had mentioned is basically bad actors acting badly in broad daylight. But I'm not concerned about China and Russia trading weapons with each other, or even Iran being in the mix in non-dollar denominated currencies. That's not a concern. Amongst the developed countries, the dollar is still the global currency, and we don't see that trend changing whatsoever. The bad actors are sort of figuring out a way to survive amongst each other, But even in Europe and most global countries, they're really not to be trusted. So I'm not as concerned about that.
Yeah. And then if the question is more related to the strength of the US dollar, just one thing I've noted is like our international developed holdings that we have in the models in the portfolio are at least two of the three in our develop are currency hedged. So as far as if the dollar changes, which I know it's declined a little bit. I mean, this dollar was strong over this past year and has declined a bit. We do have hedging from our international developed equity positions. There is some hedging involved with currency in those investment selections too.
And even a decline in the dollar, what it does is actually makes US exports more attractive. So we actually can export more when our goods are less costly. So there is a growth. So it's a little bit of like a, reverse thought process. So the dollar declining, when the dollar's strong, it's good for travel. If you're going to go to Europe and, enjoy a summer vacation, it's good because you can buy more. But from a trade standpoint, and minus that short amount of time where someone may be on vacation overseas, a declining dollar actually makes it more attractive for exports because that means our goods are less expensive as it relates to their local currencies overseas. So there again, it doesn't, just because the dollar's declining in value doesn't mean it's actually a bad thing. But sometimes we get presented with that connection, and it's not necessarily the case. Well, if there are additional questions, please let us know. Brian and I are always here. Of course, we have our next meeting always scheduled, so we're certainly aware of that. Please give us your feedback, and we'll see you next quarter. Thanks so much. Bye-bye.